This afternoon, we're going to start off with a panel, and our panel moderator is Jay Rosenblum, a local Albuquerque attorney and also board member of the Parker Center for Family Business. Jay will be introducing our panelists, and we'll have a visit about financing transitions. Okay.
Good afternoon, everybody. I'm Jay Rosenblum. I'm an attorney here in Albuquerque. I'm a member, hopefully in good standing, on the Parker Center board. It's one of my favorite organizations. And we're going to have sort of a roundtable discussion for folks. We're thinking we'll probably go about 45 minutes and then open it up for questions. And hopefully at that point you'll be invigorated and ready to throw some questions at this panel. Let me introduce folks. Vickie Wilcox has the Wilcox Law Firm here in Albuquerque. She's one of the state's very finest estate planners and business attorneys. She's been a buddy of mine forever. Very pleased to have her on the panel with me. Lonnie Talbert is Chief Operating Officer and an Executive Vice President with Southwest Capital Bank. He also serves on the Bernalillo County Commission and is also a Parker Center board member. And Tony Royle is a partner with Moss Adams, one of the state's tax and accounting gurus. And so we're looking forward to a fun panel. I put on everybody's table, and there's some up here if there's not enough over there, a scenario that we'd like to address. And what I thought would be interesting, most of the speakers who you listen to when you come to this symposium deal with some version of dynamics relating to family businesses. And it's very important and it's very interesting. We're going to take an hour out, I think, from that approach and come at the question of family business and family succession from a slightly different angle, which is what I have on this panel with me is a lawyer, an accountant, and a banker, who are, for most family businesses, the three most influential advisors to a family business. I would add an insurance person as well, typically, those four, some sort of a financial analyst. So what I thought would be hopefully entertaining for folks is for us to set up a scenario of a family, and then I want you to watch the thought process that occurs when a lawyer and an accountant and a banker are faced with questions relating to a family dynamic, how they go about resolving it. I'm going to just take a moment and read through the fact pattern very quickly. Fred and Ethel Mertz have a successful oil and gas parts and servicing business in Artesia. The operating business is called Mertz Enterprises, Inc. It's a New Mexico profit corporation. They own 100% of it as community property. Here's some pertinent details about their company. It's a C corporation. Everybody in the room has some passing familiarity with the fact that you can be taxed as a C corporation or an S corporation, or if you're a partnership, you're taxed under subchapter K. Average revenues of $5.5 million a year. Has a line of credit, several equipment financing leases, all guaranteed by the Mertzes. So far, I hope this sounds amazingly ordinary and unsurprising to you guys. Yet the company has 27 full-time employees, good profitability, enough so that Fred and Ethel pay themselves $500,000 a year in compensation and benefits. That's an important fact, and we're going to come back to it. The Mertzes owe the company $750,000 in sweetheart loans they've taken out from the company over the last 2 decades. They pay interest annually on the loans because their accountant makes them do that, but have so far avoided actually repaying any principal. The Mertzes' son is Doolittle. He works for the company. He's 46. Contrary to his name, Doolittle is hardworking and industrious, but he's not the brightest bulb in the lamp. Doolittle is heavily involved in the technical and mechanical aspects of oil and gas parts and servicing and has the title of vice president. The Mertz's daughter, Penelope, works for the company also. Penelope is 42. She has a PhD from Oxford in Shakespearean theology, but lost interest in that area after 2 years of life on the Tennessee Commune. I actually have a client like this. By circumstance, Penelope is good with numbers and works for the company CFO in the back office as a controller and assistant CFO. So remember the names Doolittle and Penelope. They're the kids. They're the kids. Winston is the key long-standing employee of the company. He's 57. He acts as senior vice president and chief operating officer. And just to embellish the fact pattern a little bit, Winston is truly the key person. He's the one that helps run the business. He's not related to the Mertzes. He's very competent, but he's increasingly distracted. At least that seems to be the impression that they're getting. One other fact pattern, the Mertzes own the underlying real estate used by their business in a separate limited liability company. And that company leases the property back to the operating company. They owe $2.2 million on long-term mortgages relating to the real estate. Okay, why are we introducing ourselves to the Mertzes? Because they're both in their early 70s. They want to begin to transition out of the business and to enjoy retirement. I've introduced Vickie and Tony and Lonnie. Their 3 advisors are each exceptional, well-respected, and expert. The Mertzes need to understand the legal, accounting, and banking implications of succession, meaning they want to know how to maximize the money they get as they transition into retirement, and they want to be secure in retirement. They make a group appointment with their 3 advisors here in Albuquerque to discuss an overview of their options with a primary eye on the financial considerations. By serendipity, all 3 of their advisors are here today, and so we're going to ask them for their initial thoughts on these various issues. So let's start with the first one. The natural scenario for Fred and Ethel is potentially to sell their business or transition their business to Doolittle and Penelope, the daughter, who may want to buy the company together. Vickie, why don't you get us started? These folks have come to see you. You can tell us whether you've represented them for a long period of time or whether you've just met them. It's entirely up to you. And give us sort of your preliminary thoughts about their fact pattern, their situation, and what strikes you as a lawyer.
Okay. Well, I'm a little concerned that they just came to see me now. This is the first meeting. And so one of the first things that I would want to talk to them about is why they waited until they were in their 70s to start planning and start thinking about a succession plan. If they've had a bad experience with an attorney or a professional in the past, I'd want to know about it because we could try to help address that and maybe ease some of their concerns and their fears. If we start digging into what motivated them now, we might find out about a medical diagnosis. Maybe they're recognizing that their children might not be the best successors. So I would open up with them just telling me, hopefully, really what brought them here today and what's keeping them up at night and what their goals are. Are they more worried about paying income taxes or estate taxes? Are they worried about leaving a legacy for their grandchildren, or do they want to leave their children with a vehicle where they can really develop and grow as professionals? So hopefully in that first meeting, they would really just explain and discuss where they're at right now.
Great, thank you. Lonnie, your thoughts?
This one on? It is. So initially, when you take a quick look at it, on balance, you think, oh, wow, $5.5 million seems like a lot of money. You start looking at what they owe already just off the top, and it's about, almost $3 million that they owe. With the Sweetheart loans, which they've been paying not down one bit, and then with the real estate. Now, the real estate's interesting because a lot of companies do just what they do. They lease back to the holding company. Or the holding company owns the real estate, leases it back to the other company. So one of the questions would be, do they want to continue that kind of a relationship ongoing, or would they want to pass that on to whoever bought the company? So there are some key items there that would then indicate. The other thing is, it talks about a line of credit, which really we don't know how much that is at this point, or how much the outstanding balance is. But, selling to children, obviously, from our perspective, we're always about the security of the deal, right? How much are we going to have in order to collateralize this kind of ongoing family business? So for us, on balance, right now, doesn't look too bad. Looks like something that possibly we could become interested in. But I think we have to sort of uncover some of the underlying components here that may or may not prohibit whoever the next owners would be from truly buying an asset that is income producing beyond what is already owed on the books.
Very good. Thank you, Lonnie. Tony, what do you think?
Well, Jay, looking at the fact pattern and the scenario, yeah, it takes a good sort of echo what Vickie has said, that you don't want to do this at the last minute. You want to try to do your planning, you know, at least 5 years in advance and maybe even 10. But I'm a person that wants to get all the facts together. And what I mean about all the facts is, of course, I'm a numbers guy, right? So we want to look at the financial statements. We want to look at the tax returns. We want to maybe take a look at the personal financial statements. We want to look at cash flow. We want to look at a lot of things. You know, and then what about the business valuations? What are these companies worth? What's the real estate worth? So you want to get all the facts together to determine what the value of the C corporation is. You want to get the facts together to see what kind of taxable estate they're looking at or not looking at. You want to line up where the kids are, you know, and are they, you know, are they interested in the business? Can they take over the business? Are they capable? And so you want to let the parents talk in terms of that fact gathering, you know, process. And then with these scenarios, you know, you obviously will want to talk to them about, you know, how they feel about each one of these scenarios. Obviously, Giganticorp, it's got a lot of money and probably risk-free, right? Write a check and it's done, right? Doolittle and Penelope, well, probably a little bit more risk there. Winston, the key employee, well, let's hope he doesn't gamble that away. In the ESOP world, that's like a whole different, you know, ball game, and but does have a tax-free component to it. So just at the surface, I'd want to get all the facts together.
Very good, Tony. Let me surf off of something that Tony said. We have 4 potential buyers. We've got Doolittle and Penelope buying the business from their parents. We have Winston, the key employee, buying the business from the entire family. We've got what we're calling Giganticorp, an international conglomerate who wants to buy the company. And we've got an ESOP. We're not going to talk in too much detail about ESOPs because we could spend a week doing that. But ESOPs, at their most primary, their most primal function is to create a buyer for businesses that in many cases can't otherwise find a worthy buyer. Happy to talk about that with people if they want to. I think we'll probably focus on the first 3. So we start with Winston and Penelope as kids, very natural sort of buyer. The subtext to this scenario that I want folks to reflect on is that we know as advisors that buyers come very differently from each other in terms of what they can bring to the table, what they expect from a transaction, what they can afford, what the problems are that they present, and so forth. And so that's what we're going to hope to sort of flesh out in this conversation. Let's start with Penelope and Doolittle. Vickie, Fred and Ethel want to sell to their kids, okay? Give me some of your thoughts about how you would protect Fred and Ethel and from their kids.
Well, so I would be interested in knowing how realistic Fred and Ethel are about their children. Do they recognize the potential issues that the kids have? So we would talk about that. Also, I would encourage them to think about succession planning over a period of time, but also a catastrophic event. What happens if they're in a car accident tomorrow? Who would run the business? And so that lends itself to the discussion of a trust and a trustee. It might be that we should have a corporate trustee who could step in and help manage the business. that would be one of our first areas of discussion. And we would talk about the fact that a trusted family member or friend could be an advisor to a corporate trustee, but by having a corporate entity as a placeholder, they can make sure that there's a good steward in place for the business and the kids aren't fighting and trying to monopolize the business during that stressful time period where mom and dad are injured. So we would start probably with the discussion of a trust. Might be a long-term goal, but definitely we would want to talk about an emergency popping up unexpectedly and having a structure in place that would protect everybody.
Great, very good. Lonnie, what are your impressions?
So I think what Vickie's alluding to, we heard, is the Mertzes are 70 years old. So that they're still running the business at that age is concerning from the standpoint of obviously that catastrophic event that could happen, and even just the unexpected, not waking up one morning at that age starts to become more relevant. So, and then the other is, Doolittle and Penelope, do they want to buy the business, or do the parents just want to sell it to them, right? They want an easy exit. Oh, it's natural. We got our kids. They've been with us. The son, Doolittle, for a while. Penelope, only 2 years, though. I mean, so she hasn't really, she lost interest, in her theology after 2 years. But, do they want to be a part of this ongoing? Because a lot of times, I think family businesses just naturally assume that they're going to hand it off to the kids. I work for a family business, and the owner hopes that his kids want to take it over, but not sure, and will plan for if they do or if they don't. But he's much younger than 70 years old, so I think the runway is much shorter. And then, once we determine if they truly are interested, then you have to determine, to Tony's point, what's the value going to be? What's the value going to be that they're going to sell to? And that will determine how we can finance it as a banker. If that value is out of the ballpark, then it may not even make sense for Doolittle and Penelope to be able to afford it.
Tony, in your comments, can you talk about how you might value the interests? What the issues would be if mom and dad, talk about valuation issues a little bit from the perspective of Fred and Ethel, and then from the perspective of Doolittle and Penelope. And then Lonnie, I'm going to come back to you and say, do you agree, and would you loan the money for it?
Okay, thank you. I can address that. First, we've got several things going on here with Fred and Ethel. But first, evaluation of the C Corporation would be number one on the list. You'd want to see what the value of the company was. And so the valuation tends to, you want to go out and hire a reputable business valuator to get sort of a pulse on what the value of the company is. And when the business valuation expert looks at the business, they'll typically will want the last 5 years of financial statements. They'll look at the cash flow. They'll want of the business. They'll want to normalize the earnings. And what I mean by normalizing the earnings, they want to take out all of the, what I call discretionary spending items that go to the shareholders. Maybe the special automobiles, the cars, the boats, etc., the fluff in the company, and also adjust the earnings for any excessive compensation that's not needed. But you go through a process to get to normalize the earnings. The valuation then is, compared to other companies that are their size by the experts, and then the expert renders an opinion, sort of a range of values. And so once the values are determined, and Vickie prepares certain documents, then you got to then determine if there's certain gifts that are going to be made over a period of time to Doolittle and Penelope, what those gifts may look like, whether they're discounted or not, whether there's certain voting rights or control. So over a period of time, you can come up with a gifting plan to gift, and oftentimes estate tax free and gift tax free as part of the plan. But But that's what I see, from a business valuation perspective. Now, on the flip side, they've got some real estate too, so that's got to be valued. There's people may have heard the term family limited partnership or family limited LLC. There's discounts that the business valuation experts take for lack of marketability and minority interest discounts. And sometimes those discounts can be very large. And some of the discounts that we've seen in practice, because this isn't an S&P 500 company. So the smaller you get, the larger the discount becomes because there's more volatility. So you can see discounts anywhere from, for a closely held business, anywhere from 35 to 70%, depending on your facts and circumstances. And then for real estate, it depends, what kind of interests are being gifted or transferred or sold. So if they're limited interest, then real estate, you can, rule of thumb is somewhere between 25 and 35, maybe a little bit more. But that's what we see in practice.
Thank you. Let me go now to the banker, because I want you to respond to what you just heard. Let's pretend the Mertzes want $5 million for their operating business, and they don't necessarily want to sell the real estate. They want to keep the real estate and have a lease and have the annuity from that. We'll talk about that a little bit. Would you make them a loan?
No.
Okay.
So, first of all, the first thing is this is a service company. So the amount of assets that they would have in order for us to secure our position would have to be relative to that $5 million net revenue tag, which they're talking about. They make 5.5 and they want to sell it for 5. So first of all, to Tony's point about cash flow, how much are their current expenses already? How much is outgoing? Well, we know they pay themselves pretty well, $500,000. So maybe Penelope and maybe Doolittle continue the same, maybe not. We don't know what the line of credit payment is at this point. That could be, maybe they have $1 million line of credit for financing of equipment. So we have to figure out what that looks like. We don't know what they're charging them on the lease yet. If we knew that, that could help. But without real estate backing security, the equipment is always going to be on a discounted rate. No bank lends 1 for 1. They typically will discount it 50% minimum. Why? Because the bank has to think conservatively. This deal goes bad. What are we going to be able to get for that security? What are we going to be able to get for that equipment? We're not going to get market value. We're going to get below market value. So from the standpoint of, yes, the price tag maybe $5 million doesn't sound bad. They're making 5.5. But I think to Tony's point, a little more detail would give me comfort. But I'd also need more security. Now, it's mentioned that Fred and Neffel, personally guarantee. That's great. That's a natural tendency in banking. We want personal guarantees. Doolittle and Penelope aren't as seasoned nor have that backing at this point. Their guarantee would be necessary, but what would be behind that guarantee? What do they have in terms of assets and security that could make us want to make a $5 million loan?
Very good. Vickie, give us your thoughts, and let's say that Fred and Ethel are unsuccessful at convincing Lonnie to give them $5 million. How would you structure, and what are your thoughts about structuring just a straight seller financing to the kids?
Well, we would talk about different types of notes, maybe a self-canceling installment note, and that would be another time we would get the team together and rely on the CPA's advice. We could use a defective grantor trust. There's a lot of different vehicles that we could put into place, but I would be a little concerned if the bank's not willing to lend the money for the transaction. Do our clients want to take on that burden? Because if it's not a good bet for the bank, is it really a good bet for them? So we would have a hard discussion about that as well.
Very good. Let me, I warned the panel that I wasn't going to be able to restrain myself from making my own comments, so I'm going to dig in. One of the things that struck me as we came up with the fact pattern is that one of the questions that has to be asked is, what is the relationship between Doolittle and Penelope? Okay? Parents do this all the time. They say, okay, our kids are involved in the business, I'm going to sell it to the kids. Okay? but they're mom and dad, and they have their relationship in terms of the decisions that they make. When kids come into positions of ownership, you've got a different dynamic, okay? And it really has to be thought through in terms of what if they don't agree with each other? What if they want to get away from each other? What if it doesn't work out? Who actually has the power and the control? You have a separate commercial transaction going on when parents are selling to more than one child or leaving a business to more than one child. You have to deal with the ownership interests and the inherent conflicts that can arise among siblings and kids. That's just a comment I want to make. Let's segue to Winston, okay? Now, Winston is a natural buyer. Winston understands the business. He's been running the business for a long period of time. They are reliant on him. He's 57. Let's go through the same analysis, which is they want $5 million from Winston. Lonnie, does that change your perspective at all in terms of loosening you up a little bit so we can get $5 million from you?
Yeah. You know, unfortunately, Jay, probably not. I mean, Winston's got obviously the backing of understanding the business and being the key operating individual of the business. So he's got a lot of experience, which is helpful, right? As you're looking at it, you're saying, okay, this guy probably knows what's going on. However, you know, if he really does have a problem with Camel Rock Casino, well, and we were to become aware of that through his personal financial statement where we'd see a lot of outflow, that would give us pause and concern that obviously his ability personally, should the deal go bad, would be strong enough to carry it. And unfortunately in banking today, you know, and our bank is pretty, we take good risks. I mean, we're comfortable taking flyers on a few things, but it's always calculated. And it's calculated to the extent that we know what we can handle in terms of our risk profile. $5 million is a very hefty risk profile without $5 million of security backing it up. So right now, without Winston coming to me saying, look, I've got this $5 million ranch that I haven't told anybody about, and you know, I'm willing to put that up to buy the business. For me, it's going to be hard for me to come up with the asset base that's going to secure still a $5 million deal.
Very good. Vickie, I'm going to change the fact pattern a little bit because I'm going to change your client.
May I comment on
Yeah, go
Winston
ahead.
quickly?
Yeah.
Sorry to interrupt.
Go ahead.
When I read this part of the fact pattern, I had to double check the agenda to make sure that Professor Rich Brody wasn't speaking, because this is his fact pattern for fraud inside of a company. He talks about a 3-point diagram that you look at to look for fraud. One is a need, and we have Winston as a gambler. The other is opportunity. He's a key player in the company, probably has his hands on the books. And the third is justification. And you can just hear him grumbling about the kids, getting all of the opportunity, and he's worked there longer, he deserves it. So in my mind, that this fact pattern would be a reason to call Tony and talk about a forensic accounting, maybe do a little digging and make sure there wasn't any problem in the books.
Yeah, I've had that experience in a little bit different way. I had a client who had a fairly good business. I'm not going to name any names, but or line of business. But I did their tax return and everything, and so the husband started to gamble a little bit. So I started out $20,000 one year, $80,000 the next, and then the third year was $350,000. And I looked at the net income, and of course they lost a lot of money in the gambling. And so I called the wife and talked to her, and I said, you know, I hate to pry, but I'm your accountant, obviously, and I think your husband has a problem. And I've mentioned it to him a couple of times, and she says, oh no, he gambles for stress relief. So he gets all his projects in the morning, and then he'll go to the casino in the afternoon. And I go, oh, that's interesting. I goes, do you know how much the stress relief has cost you? It's cost you over $200,000 last year. and he could get weekly massages for a lot less. And so I says, I would really, I don't mean to pry in your personal life, but I do have a duty to, as a person, as a human being, to mention that to you. So the next year he comes in, and boy, the gambling is way down. It took a nosedive, and I was thanked for bringing that to their attention. So that's like a real life kind of thing.
Do CPAs have to get waivers of conflict of interest?
We do.
You do? 'Cause
We do.
we would be in trouble if we went behind one spouse's back to talk to the other spouse. I mean, I think ethically that's very appropriate, but
Yeah. Well, they're like a joint tax return. But,
So-
I've been mentioning it directly.
yeah.
And to them. So, but yeah, you do have to be concerned about conflicts of interest.
Yeah.
You do.
That's another topic.
Absolutely.
Well, it's interesting. I think I applaud Tony's courage
Yes.
in this respect, because it goes to what makes a good advisor, which is to tell truth to power, which is your client. It's not always that easy to tell them the truth about what you're saying, but it really is a fundamental responsibility of good advisors. So, okay, Winston has a dark side, and Winston, we're not certain what's up with Winston. I was going to change the fact pattern a little bit, which was I was going to make Winston Vickie's client.
Oh, no.
And I was going to say, okay, now Winston is your client, okay? How do you go about representing Winston? Now, you can tell us whether you know the dark side or not, okay? But how do you go about representing him in this conversation with Fred and Ethel about his interest in buying the company?
I guess I would have him leverage his knowledge of the company, because it seems like that's really where he's set apart from everybody else. From this fact pattern, he's the only middle management option that they have if they want to continue the business. And so we would work together and brainstorm about how he could use that knowledge, experience, expertise to negotiate some type of deal with the owners of the company.
Gentlemen, any other thoughts? Tony?
Well, yeah, Winston is in an interesting situation. Doesn't seem like he has very much money, but a lot of experience. And so, yeah, the bank's not going to want all the money. He probably doesn't have but his house. And so then he has to look at some kind of secondary market to get a loan. And that's going to be very, very expensive for $5 million. And so, he may want to shop around. I mean, and maybe get, some angel investors or, put together a business plan, right? I mean, say, okay, Winston, if I was, basically Fred and Ethel, I said, okay, Winston, what's your plan? And can you reduce that to writing and show me how this is going to work? And go home, go wherever, but think about this and come back and talk to me when you have everything written down, planned out. So I can see if this is going to be a success or not, because the last thing I want to do is to have this business back when I'm 80 years old and you're gone and you've run it into the ground. So, I mean, that's what
that's the whole
really
point.
being worried
Yeah.
about.
Vickie?
We might talk about a buy-sell agreement for a portion of the stock. I think the owners are probably too old for insurance at this time, but as you mentioned earlier, having an agent involved in the discussions can be a key part as well. But there could be some options for some type of purchase arrangement for some of the stock for Winston.
Vickie hits on something that I think is very important and very fundamental. And Jim, I'm sure, agrees with this. I'm sure he's done it in the past for the lawyers in the room. A lot of times when companies are thinking about selling themselves to key employees, they do it in stages. They say, you can't afford to buy me out entirely, and I don't know that I want to put everybody's destiny in the hands of the key employee, but I could sell you 5% to start. I could sell you 10% to start. I could sell some of it for cash and give some of it to you for services and that kind of thing. And so you see this staging that happens over 5, 6, 8 years where people get to a place where they're going to take control. Let me give you one quick little factoid. If ownership is 100%, meaning there's 100 points, what's the most valuable point among the spectrum of 100? You guys know this. It's number 51. Okay? 51 is more valuable than anything else on that spectrum because that's when you get control. So what happens with key employees is you move them along as minority owners until you feel that moment is right where you can give up control and that 51%. Vickie?
So one other option too is to do a recapitalization and have voting and non-voting stock. And so they could give away 99% of the company that's non-voting stock and keep the 1% that's voting stock. And that can be another way to maintain the control through the transfer to the employees or the children or other investors if they were going to go out and get third-party investors.
All right, very good. Let's turn now to the fact that Fred and Ethel have talked with our advisors. They're now thoroughly deflated about the idea of selling their business either to their kids or their key employee. And they do what so many clients do at that moment, which is say, gosh, I need to sell it to a real buyer, a real company. I need to go out into the market, and Gigantic Corp is out there as a buyer. More realistically, what happens a lot of times is people will start to think about selling their businesses to competitors that they've had good faith competition with over the many years, and they know about these people. I've seen this dozens of times where there's really vigorous, robust competition, and then all of a sudden the business gets sold to your competitor. But let's talk about third-party buyers. Lonnie, you want to make comments?
Yeah, thanks, Jay. Well, I think, this probably provides the best opportunity for all parties. Why? Because most likely they could cut an arrangement with Giganticorp to keep Doolittle and Penelope on as key employees for a while, or hopefully maybe for a longer term, so they can continue to be a part of the business. And they have that institutional knowledge that if they just got rid of them, especially in Artesia, they would want to understand that whole market down there. Same thing being with Winston, and really, at least at that point, determine if he truly is going to be capable or if his gambling habit is going to overtake him. It also gives, the Mertzes, who you can't negate the fact that they're 70 years old, and they don't have 10 years to wait to be paid out. I mean, if they truly want to enjoy their retirement. At that point, most likely, you think about it, if they sell out, and Doolittle and Penelope have been good kids, they're going to get the company at some point, at least the proceeds from it in the future anyway, most likely in an inheritance. So I think, at least as it relates right now with the facts, it provides them their best opportunity for everybody to be taken care of. As bad as it sounds when you sell out to a giant corp, we just had a customer the other day who was local and local and local and always was going to be local, and then all of a sudden someone comes along and makes him an offer he can't refuse. And he's like, okay, do I continue to say I'm going to be local or take care of my family for the rest of my life? I'll take care of my family for the rest of my life. Oh, by the way, I'm still local because I'm not going to move and leave New Mexico. So I think this provides right now the best opportunity for everybody involved.
Very good. Vickie, Tony, thoughts?
Well, I've got one thought. In the tax world, when you have Giganticorp, you've got to decide, well, do I want to pay taxes or do I not want to pay taxes in terms of structuring this deal? Because under a provision of the Internal Revenue Code, under 368, there are provisions to do this deal tax-free if it's a stock-for-stock exchange. And then the basis of, the company, it has a carryover basis. And then when Fred and Ethel want to sell the shares, over a period of time to provide for cash flow, that's when you'll realize a capital gain, is when those shares are sold. Now, if what happens if you're caught dead with those shares, right?
Right.
They get a step up in basis and you don't have to pay income tax on the shares. So that's an overall observation.
Vickie?
Well, along the lines that Tony was just talking about, I would encourage them to think about their philanthropic goals. They might consider putting some of the stock in a charitable remainder trust. And we've been talking about how old they are. They're in their 70s, so they might want to do it for a period of years. They might want to do a charitable remainder trust for their children, but that could be a way to defer some of the big income tax hit that they'll have when they sell it. I'd also encourage them with this fact pattern especially to get a non-disclosure agreement in place before they start having the due diligence, because we don't want everybody else in the world to know about Doolittle and Penelope and Winston and some of the other problems that might be lurking.
One variation on that, one additional thought with the charitable remainder trust, because that's like level one, taxable versus non-taxable. And with the charitable remainder trust, I've used that a handful of times with clients, and when it works, boy, it works really well, because you get an income tax deduction when it's your trust, right? You form the trust, you contribute property to the trust, and you get a current income tax deduction for the remainder interest today without paying any money, right? And then when the shares are sold, when the trust sells the shares or a portion of the shares, they escape taxation.
Right.
Right.
You just pay tax on the money that comes out. So it's a percentage or a fixed amount that comes out each year. And also the charity gets to benefit. So we could name the Parker Center as the remainder beneficiary.
Yeah.
Let me add a couple of comments to this conversation. We've talked about sort of natural buyers, which are kids, key employee, and a third party that's in the business. There are 2 or 3 things that I just want to put on the table. If Fred and Ethel had come to see me to start, I would want to have 2 conversations with them. The first is, if they want a certain amount of money, I want to go to what Tony and Vickie have been talking about in terms of the taxes. I want to know how much of that money they're actually going to have after they pay taxes. When I first started in practice, I wasn't as attuned to that as I am today, okay? And one of the things that happened is you'll see you're going to get $7 million for your business, but guess what? You only ended up with $3 million or $4 million because the tax planning wasn't done as astutely as it can be. So I always try to get good accountants involved to do an actual analysis that says, tell me if we do this deal, no matter who the buyer is, at the end of the day, what do Fred and Ethel, what are they going to have net of tax or net of expenses, net of mortgages, you name it. What are they going to take off the table? Is it worth doing? I've had dozens of deals where people have looked at that net number and said, oh, I'm not doing the deal. Okay? I like that number, but this isn't but if this is the number I'm going to end up with, I'm not going to do it. That's number one. Number two is this. I put this sentence in the scenario on purpose because it's a problem for people trying to sell businesses in the United States, which is, I put in there that they're taking $500,000 a year out of this business, and they're going to get $5 million for it. All right? So presume that after taxes, they have $3 million, and that they invest that $3 million. Can they invest the $3 million in prudent investments to throw off $500,000 a year? Maybe, maybe not, okay? And one of the problems that's happening is that people are being trapped against their salaries in the sales of their businesses. They're making so much money out of their family-owned businesses, when they get ready to sell, they're not going to be able to take what's net and invest it and approach it. And so I always have a conversation with the client that says, are you prepared to live, have your lifestyle adjust to whatever this money is going to pay you in terms of investments, okay? So it's just a clarifying conversation. I've had many clients say, yeah, I understand that, I'm gonna do it. I've had more than one, though, say, oh, that's an actual problem. Okay, so we're at the end of our session. It flew by, I knew it would. I'd like to ask you guys for some final thoughts about our scenario. And then we got about 10 minutes, and so I want to open it up to you guys to get free legal, accounting, and banking advice. And how often does that happen? So go ahead, Vickie.
I guess I would piggyback off of something Tony started out with, which is the more time that we have to plan, the better. And I encourage clients to think about the SWOT test. I did not think of this, I read it, but it's looking at your business and documenting, writing down the strengths, the weaknesses, the opportunities, and the threats. And the more time they have to address those different features, the better position we can be in as advisors to help them have their business in good shape for the sale or whatever transition might come along.
Great, thank you, Vickie.
I like what Vickie said around, the time horizon as you start recognizing that your business, you're not going to be doing your business forever. You have to decide, is it the sale of your business that you're focused on? That's how you're going to retire. That's one way to look at it, which many small businesses do. They say, well, I'll just sell my business and I'll retire. Well, there has to be something there to sell. And that something there to sell can't be you. Meaning if you're the business, you can't sell yourself. So you're selling something that they're like, okay, well, if I'm not getting you. And my father ran into this. He had a business for 40 years and he decided to retire. And my stepbrother didn't want it because he had been working for him, and it ceased to exist because no one was buying his inventory. They wanted him. Well, he wanted to retire. So I think you have to think about that seriously, is what is your real plan for selling that business and what is that value proposition?
Tony, thoughts?
Well, I go back to one of the first things I said, is to get all the facts together. Over the years, I've heard statistics on and seen it in practice about what's the probability of a family business being transferred to the next generation. I mean, has anyone commented yet on that aspect in today's symposium? Well, it's probably about less than 1/3. And so planning is very important. So you want to be one of those 1/3 that successfully negotiate and transfer your family-owned business. Now, there's a hierarchy to businesses. And so there's the generation that builds the business, the matriarch or the patriarch or both of them. The next generation is called the maintainers. They didn't build the business, but they can be taught to maintain it. And then if you get lucky enough to get to the third generation, they're the receivers, or like the trust generation, right? They want to receive money from the business. And so being aware of where you're at, with your business, or the generation that built it, or the generation that's maintaining it, what are the dynamics there? But get all the facts together, understand where you're at, and plan. That's, I think that'll do it for me, Jay.
Great, thank you, Tony. Folks, we want to open it up to questions, and hopefully there are some. Any thoughts from the audience? Sir.
I'm not surprised that the bank doesn't want to loan anybody $5 million. I don't want any of that deal either. It seems to me that the scenario created, and a lot of small business people have this, they have in mind what the business is worth, but in fact, it is worth significantly less than that. Because it looks to me like what the Mertz has really been doing is stripping all the earnings out of this business for the last several years. And in fact, if they were to pay themselves an adequate salary, you might find out that the actual earnings of the company are only $300,000 or $400,000 a year, which on a 6 or 7 multiple is generous, might be only $2 or $2.5 million. And they just pretended that they own a $5 million business because they've been building no value inside the business.
Very good. Any other thoughts? Questions? Okay. Thank you, folks. It's been fun. Thank you very much.